Well, why don't I get started and then we'll see, have more people joining us. Well, welcome everyone. I'm Yvonne Schwab, ACG Silicon Valley CEO. I am excited to present you today's event, Managing International M&A in the Sea of Disruption, in collaboration with Vistra. For those of you new to Silicon Valley, we are the leading business-to-business networking organization in Silicon Valley, providing connections, thought leadership, and enabling personal and organizational growth. ACG Silicon Valley is offering a variety of virtual events in the coming months. Tomorrow, we have a joint event with our sister chapter, ACG Boston, on technology investment trends from coast to coast. And on Thursday, we are hosting our round robin networking with ACG San Francisco. These are always fun, so come and join us. Next week, we have a live mastermind on risks and solutions for 2021 with the amazing Deborah Bringelson, a leading business growth authority. Many more events to follow in May and June, so we invite you to visit our new and improved website, acgsv.org, to see the full calendar. A few housekeeping items for today's event. Please stay muted during the panel discussion. Once we are finished with that, we will have a Q&A session with Peter and Saul. If you can, please submit your questions into the chat box or raise your hand during the Q&A session. Of course, this event would not have been possible without our amazing sponsor, Vistra, so thank you so much. Without further ado, I would now like to introduce you to our moderator today, Peter Caddison. He's a partner at Vistra, a global accounting firm with offices in 46 countries in 80+ jurisdictions. Vistra specializes in cross-border accounting, compliance, and global human resources support. As a result, Vistra brings a unique perspective to international M&A. We look forward to an interesting discussion. So let me just share my screen here. Enjoy.
Okay, I'd like to welcome everyone to our International M&A panel discussion today. My name is Peter Caddis. I'm a partner at Vistra, and I manage our U.S. corporate sales team. I'm joined today by three of my colleagues, Tom Lickus, who manages our international tax team, Saul Howerton, who runs our global advisory practice, and Anastasia Williams, who's our U.S. private equity practice lead. For those of you that may not be familiar with Vistra, we may be the largest accounting firm that you've never heard of. We're nearly $1 billion in revenue, 5,000 professionals. We provide services in over 80 jurisdictions, and our specialty is cross-border accounting work, compliance, and global HR. Hence the discussion today in terms of international issues for M&A. So what we'd like to do is focus on what are you leaving on the table when you're looking at deals, how to maximize valuation as the seller, how to avoid unexpected liabilities as the buyer. And we're going to kind of think of this sequentially in the context of 3 stages: actions to be taken pre-deal, during the deal, things to look out for, and actions required for post-deal. Tom, let's start with you. What are the most obvious housekeeping points that a portfolio company can take initially, and those things that would have a direct impact on valuation, and why is this so important?
All right, super. Thanks, Peter. I guess, firstly, in my experience of preparing organizations for sale, there are a number of base level housekeeping elements that both reduce attractiveness and conversely increase attractiveness of a corporate group or portfolio entity. Firstly, the detractors. Okay, these are elements such as historic compliance and governance. Matters such as timely document retention, preparation, lodgements and payments, matters that are immediately identifiable as part of a due diligence, and indeed a poor audit trail in this regard will cause potential purchasers to dig further and question perhaps the underlying integrity of positions taken by the company. However, just as these elements are perhaps readily identifiable as part of any due diligence, so too they are readily correctable prior to any potential sale process. Historical lodgements, non-compliance, these can be brought up to date, creating a clean or cleaner portfolio. On the upside, however, an entity or corporate group that has met all the requirements and governance requirements and compliance requirements on time, every time, gives that instant upside. Finally, there's the raft of operational matters you could consider, which will increase the attractiveness of a portfolio company. For example, ensuring that the people, the processes, and the technology are all aligned and streamlined, ensuring that cash flow is tight and turns around quickly, ensuring that IP and assets are in the right places, are highlighted, protected, and maximized. Peter.
Thanks, Tom. And I know you've got several projects here where you've come across companies that have structures that may not be optimal. We have a clunky internal term we call entity rationalization. How do we clean them up? How long does it take? And what is the ROI you've seen on some of these situations where you've been able to re-engineer the corporate structures?
I guess like all the best questions, Peter, there's a simple answer, which is correct, but which leaves a lot on the table. And there's a practical answer. The simple answer here is that corporate entities can be struck off at the stroke of a pen. Then there is, of course, the however, which leads to the more complete answer. I guess the time frame taken to remove an entity from a corporate structure as part of a wider rationalization process in order to get to a more streamlined group structure for sale depends on an array of factors, such as has the entity ceased trading? Has the entity ceased to employ? Are there existing contractual obligations, both to customers and in respect of items such as leases? Obviously, are there outstanding compliance obligations? Now, taking a step back, Peter, however, the question goes to the pre-sale tax-efficient corporate group cleanup, a process we often undertake. In this regard, the process does not simply involve reviewing the corporate structure and striking out entities. For example, whenever there are duplicate entities in country, there's perhaps homework to be undertaken first, not only in respect of the mechanical items just listed, but also in terms of understanding which entities are to be removed. For example, looking at the potential impact of wider intergroup supply chains, something that seems obvious, but is always worth double checking from an operational perspective. Looking at any historical tax attributes. For example, there was a recent matter whereby an entity had significant tax losses that would have been lost or disregarded when the entity was ceased. Thirdly, are there tax attributes associated with specific asset disposals, for example, returns of capital? Tax should not lead the commercial drivers, but as tax is the second highest cost of doing business after employees, tax should certainly be a relevant consideration, and all decisions should be tax informed.
Thanks, Tom. So from an HR standpoint, I know there's probably a whole host of issues related to the same question. Can you give some examples of situations you've come across, and are there any important focus areas that need to be taken care of in a situation like this, where you're inheriting a very large and complicated structure?
Yeah, I mean, the list of issues that you can run into clearly is going to be pretty vast. Over time, we do tend to see some similar type of issues that our clients are going to run into, and things to be considered. When we look at the deals themselves, Oftentimes there's some variability around whether it's an asset deal or a stock deal. So that's going to present some challenges around, do you have an actual structure or framework in place already for these employees? The asset deals tend to be a little more complex and require extra speed, I'll say, to set up the structure and transfer those employees across, as you likely don't have an existing structure to lean on. So, in a lot of cases where that happens, of course, hopefully you've done some good diligence up front and you're able to lean on that from a knowledge-based standpoint and at least understand the current landscape of the employees. But, unfortunately, there are oftentimes things that come out of the woodwork when you go through that process. More particularly to some of the asset deals, and if you have some elements around the employees for potential transfer, or maybe you're making some staffing changes, there are some protections in place, of course, for some of those employees that you do have to watch out for, both within the EU, the Acquired Rights Directive, and then in the UK with TUPE around transfer of employees. So those are some very high level elements that you may find yourself bumping into when you try to potentially move those employees and transfer them across. You need to make sure that you're aware of some of the requirements to ensure the employees are no worse off from moving across. Understand what their current benefits and entitlements are to make sure you do match those again as well. Just a few in the early stages there, Peter.
Yeah, we'll do a deeper dive in a few minutes here on some of the human capital aspects of this. Yeah. So Anastasia, you're on the front lines of these deals. In your experience, we'll go to 10,000 feet here for a second. How prepared are companies in advance of a deal, and how well do they understand the specific issues around the international landscape?
Yes, thank you. So as Peter mentioned, my team gets involved from the buyer perspective, and also private equity buyer, and at the end they sell these companies as well. So from that side, preparedness is interesting. We just don't think that the headquarters usually knows, what do they have on the ground or don't have on the ground. As simple as the state of the entity that Tom mentioned, right? The rationalization or understanding, is that entity ready to be sold? And if it's not, how much of a delay will it cause in your transaction? And that is the simplest thing that can be solved, but can have very, very important consequences. Delay in close, everybody suffers. It's high cost at the end. So we do work with the actual portfolio companies to understand, are you ready to be sold? To do that evaluation, we have Saul's team that comes in as a advisor on the ground with the people on the ground that understand a simple check with an agency can solve that very quickly. So that's how we get involved as Vistra on the private equity due diligence or sale preparedness.
Well, I think you've given a good overview as far as some of the initial hurdles of timelines, et cetera, in getting entities, set up. When buyers and management think about normalizing operations, what are some of the issues regarding transitioning to TSA and moving to NewCo and getting that new management team up and running things independently?
Yes, so as early as before close, the management company of the new portfolio company would be thinking about, after the TSA, 6 to 12 months down the road, what is my long-term plan? And it's very nice to rely on the TSA, but it does expire, and it is a costly agreement between the buyer and the seller. At that time, the seller is done with the sale, and they'd rather not be, taking care of your back office. So you need to think about what is your long-term approach to payroll. just ongoing basic payroll. What is your long-term approach to compliance? Do you have enough employees, or is it worthwhile to have a full back office in the location? If it's 5 employees doing just business development, maybe you don't need to be hiring accounting and HR professionals. So we sit down at the table just before close with the management company, and we discuss and help what is the balance between insourcing and outsourcing of all your international locations.
Thanks, Anastasia. So let's turn back to the people side of the equation. Human capital is a key driver of value. IP can walk out the door. There's a lot of upheaval and insecurity, perhaps, with a change of ownership. Can you talk a little bit about, what can go wrong in situations like that, and how can management teams be proactive in eliminating that as a factor?
Yeah, and I think some part of this is, as best you can, diligence up front, really trying to understand the existing entitlements, understand what is in place currently for those employees. Obviously, there's going to be a lot of uncertainty. You're going to have some, maybe some fear within the organization and the employees that are impacted. So understanding the initial landscape, I think, is really important, just to level set with what your base level of support, base level of coverage is you're going to need for your employees. I mentioned previously about some limitations around the movement or transfer of employees, and that's one element where there will be some limitations. But also, there's going to be limitations around making sure the employees aren't impacted as a result of the change. So, for instance, you need to understand what level of benefits they're currently receiving under their prior organization, and move that forward, let's say, into the new organization, because you're in a carve-out deal, you're going to be setting it up anew, and you need to make sure that they're whole. That could be general supplemental benefits, it could be other entitlements that they have. Where you run into challenges is, by design, you're carving out a lot of times a smaller population of employees into a new entity or new corporation. So you don't have the buying power. You don't have the employee population that allows you the ease to offer the same level of benefits. So sometimes that can be a bit of a gap. So that's really the importance of understanding the initial landscape and then where you need to get to. And I would say not just from a legislative standpoint, but also from a best practice standpoint, making sure those employees do feel valued, do know that the structure is there to catch them when you go through this type of a process.
When staff reduction is an issue, how are terminations different outside the United States? And, I understand there's not at-will employment. Can you give us some examples of what that might mean? What sort of landmines might be an issue?
Yeah, it's a really good point. And I think good or bad from a U.S. employee standpoint, we do have at-will employment here. You find that in very few, if any, countries outside of the U.S. And so it's really important to know, again, there will be limitations as a result of a carve-out about your ability as an employer to reduce your staff. A lot of times those protections are in place from a length of period at least. So there's that piece. But then, as you go forward, and if you do intend to consolidate resources or combine organizations, other countries are going to have service levels of obligation where you have to meet from a severance standpoint. We oftentimes will lean on somewhere like France, where it's very hard to separate from employees just in general, much less through a carve-out process. And you should be expected, really, truly, to have to pay severance in the neighborhood of 6 months. I know that sounds excessive in some cases, but in reality, that is what we find. So that's something that's really important as a buyer to understand. If you haven't priced that into the deal, that it's not going to be as easy, perhaps, to make some adjustments along those lines simply due to the severance requirements and termination. The other slight piece to that. And there's going to be a number of countries, whether it be Latin America or Europe too, they're going to have collective bargaining agreements in place. So those countries, there's a timing element, is you're going to have to consult with the collective bargaining group there to see what options you have available. But there's also time, right? It's going to take time to go through that process as well to get approval and or buy-in. So again, those can really impact deals, not just from ROI, but from a timing standpoint too.
Tom, from a tax perspective, one of the key areas of focus is the purchaser of a new business. I'm thinking either pre-deal or first 6 months to make sure things go well, run smoothly.
Super, thanks, Peter. I guess just on the pre-deal phase, a point that Saul made just to add to that, we as an organization do a lot of work in terms of the preparation for sale, reducing the number of boxes on the international board, okay? Obviously, the pre-sale corporate group cleanup, there is a lot of work to be done there. But don't necessarily not do that simply because the transaction is pending. We've been involved in situations whereby from an HR, accounting, tax, legal perspective, simply starting the process can illustrate to a potential buyer that there is upside to be gained in, for example, identifying 10, 20, 30 entities around the globe that can be rationalized, that can be struck off. If we think about the myriad of compliance obligations from management accounting, financial reporting, audit, corporate income tax return, VAT, GST lodgement, payroll, when we replicate that across 10, 20, 30 entities internationally, we can be talking hundreds of thousands of dollars of outlay. Okay, simply beginning with the end in mind, even if the seller, even if the vendor does not complete that process, for a purchaser, the ability to see that potential upside in a streamlined group under their watch, particularly in, for example, a private equity transaction, whereby the actual group may be on-sold again, the ability to illustrate that they have streamlined a group under their watch has potential significant upside. However, to deal with the second part of your question, if I may, Peter, the post-acquisition phase. Looking at the first element of the question, I always begin with the end in mind, i.e. prior to acquisition. Prior to acquisition, the potential purchaser needs to determine what is the purpose of their acquiring the international entity or the portfolio group in question, i.e. what is the potential end game here? For example, is the acquisition a strategic play into a new market or to acquire a new product line or a right to IP? Or is the intent to buy with the aim of realizing inherent value in the group? Think about it, where I'm coming from here is the pre-acquisition planning. For example, if you're acquiring a group with a view to acquiring IP, should you acquire the group under an IP-efficient holdco structure? Or if you are acquiring a group with a view to potential realization of capital gains, do you acquire the group, for example, under a structure? And again, do you acquire the group under a structure whereby, for example, the jurisdiction, the holdco jurisdiction, doesn't levy capital gains tax? Okay, so beginning with the end in mind is key for that post-acquisition phase.
Thanks, Tom. So Anastasia, back to the front lines. What are the types of real-world problems that you've seen, during the initial phases of a new transaction?
Well, the real world, and that's what, the practical, right? A simple incorporation. Oh, we can do it in 2 weeks, right? Yes, technically. But some countries say you have to have a bank account, which now with new KYC laws could be more than 2 weeks. Even we have to collect all the KYC by that time. It's 3 weeks past. Plus the 2 weeks, just basic incorporation. The availability of local representation requirements by countries like directors or legal reps All of that just needs to be just an expert that knows 1, 2, 3, 4, 5 before you incorporate, and then it's 2 weeks. So realistic timelines set at the front of your beginning of the transaction, set at the front with the buyer and the seller, and getting it started the correct way, so there are no frustrations down the road. Something that we should mention, probably COVID. On one hand, an amazing volume, amazing opportunities for strategic buyers, for private buyers are out there, and that's met with the opposite, right? COVID, nobody knows how to handle it, and it just has delays. There are agencies that are still closed, shut down. And we're all learning. What is the workaround? Is there a different type of entity we can incorporate and then switch? These are the discussions we're having, or just put it in delayed closing, just based on our experience. Let's put, Argentina to delayed closing now, and not frustrate and overpromise to the seller or the buyer anything we cannot do. So those are just the practical everyday issues we talk about.
Shifting to a couple technical topics, on some recent transactions I've been involved with you, Anastasia. Corporate governance and director services in particular, have been, a real difficult area to address, because, there may be transitions, and during the setup, there may be, an individual may hold that director position that might transfer to an employee, et cetera. Any rules of the road in regarding director services and corporate governance in general?
Yeah, I do think that it gets downplayed quite a bit in the industry. Oh, it's just, a dormant entity, and it's just a simple directorship, you don't do anything. I think the understanding from legal perspective and risk perspective, it's an individual risk. So not every company, not every country, not every employee of Vistra feels comfortable to do that. And we try to find a solution. There are countries that, for 2 to 5 years, you could be liable for anything that happens before or after you are a director. So we try to limit that. We try to help. And as soon as possible, as the transaction closes, we transition that to a director that can deal with an operating entity, or is an employee and covered by all the insurances that need to be covered. So it sounds simple, but it gets hairy.
So Tom, tax authorities around the world are on the warpath. We see digital taxes being proposed, and there's a lot of controversy about U.S. tech firms and permanent establishment risk, and have you created a tax nexus? Has any of this impacted any of the deals and the structure of the deals that you've seen?
Yeah, I guess just to add to what Anastasia said, it's the uncertainty, Peter. There are massive opportunities, there are significant opportunities, but there is also significant uncertainty there. I mean, if you look at a base level requirement, your cross-border international transfer pricing documentation, there was a recent transaction whereby all the documentation was premised on the basis of a pre-COVID world, okay? But obviously in a post-COVID world, supply chains have changed, the benchmarking had changed, and indeed the thresholds had changed. So for example, the entity in question, the group in question, was a software provider whose thresholds had gone and crossed the 40-50 million threshold on a global basis over the past 12 months. Therefore, the reliances from a TP perspective that they'd placed 18 months ago no longer held true in a post-COVID world, which for an organization up for sale certainly impacted its potential valuation.
Saul, you see such a variety of issues across your desk as someone who manages global mobility, global HR. You do get involved in tax and some of the other accounting areas that we provide consulting services on. What's the single most important area of focus that would have the greatest impact on a deal that you see, if you just were to summarize before we go to Q&A.
Well, I think ultimately it really comes down to ROI of the deal for me. I think when you package it all up together and we kind of look at some of the challenges our clients going to face, ultimately trying to get the biggest return on investment. I'm going to always kind of come back to human capital as being that largest area for upside. So you're buying this piece, you're carving out this piece of business that has a lot of inherent IP, and oftentimes that IP resides within the employees that are a part of that organization. It's incredibly important to make sure you do all that you can. Clearly, you're going to have to remain compliant and keep the employees whole from a benefits and comp standpoint, but there's upside there too. And the last thing you want to do is have the employees actually be unhappy with the result of the transaction, perhaps left in the dark, not communicated enough with, so they don't really understand what's happening and don't see the end goal and the upside that they might have as a part of the new organization. So the last thing, again, you want to have is that IP to walk out the door, as does your ROI. So I think it's super important to ensure that you're actively engaging the employees early and often, that you're taking a broader view, I would say, about not just what, let's say, they used to get from an entitlement standpoint, but what should they maybe get? And this is really topical because we're seeing a lot of our clients change their structure of not just compensation, but benefits too. And they're more considerate about wellness, about employee assistance programs, as we've been through some hard times more recently. And taking a look at your existing benefits plans and entitlements, there may be new areas actually that the employees would prefer versus that old gym membership you used to have. Things like that maybe aren't quite as important to them. And those are real areas of demonstrating commitment to the employees and potentially improving their current offering, while you may even actually save a little bit from a cost standpoint too, improving that ROI.
Anastasia, we talked about how critical timing is on these deals. Can you talk a little bit about the employer of record solution?
Yes, Peter. Yes, the time is against you in M&A world. There's a deadline. Interestingly, we find interim solutions, which is one of the examples we just had with a client. There were some entities that weren't going to be ready by the close date, but also, all the benefits and HR pieces needed to be in place. So we looked into our internal advisory group with Saul and got him involved to talk to the client. And I believe that was a good solution, good advice. Saul, why don't you just go over what we actually looked into as a solution for this problem?
Yeah, thanks, Anastasia. I think time, of course, is going to be a challenge for us. But with that always in mind, because it seems like we never have enough of time to get structure set up, we do evaluate other options that you might have available. And then a lot of times these deals that have a lot of speed within them, it's going to take longer than you can allow to set up a subsidiary in some of the more challenging countries. And that's oftentimes where an employer of record or PEO type of an arrangement will work well. And we got our clients to ensure, and certainly with the help of Tom's team, the tax space, to make sure that it's fit for purpose in terms of the activities in country, number of employees, and what you're trying to accomplish in each of the individual countries, and make sure that that is a good fit as well there. And then kind of piece together the various options and bring to the client what makes the most sense. And meets their ultimate goals, from that day zero mark.
And just to clarify, we're talking about a interim payroll solution that could be set up rapidly. We can replicate the benefits environment, when the permanent payroll situation is ready, fit for purpose. And this way you can avoid any retention issues with key employees by making sure that you've got your payroll set up properly.
Yeah, and just to add, that is one thing you don't want to mess with. The people with a new owner need to get their paycheck exactly on time. Otherwise, you're going to have a problem. So payroll just has to be done.
Yeah, and at times I think, Peter, the other thing we do find is where you only have one employee in one country and you have no intention of growing that market. It's a really great solution at that rate. So that's the other benefit of that model.
And then Tom, tell us about your team. I mean, when do you run into a permanent establishment risk question where this solution may, grow beyond its original purpose and create a problem for the employer?
Sure, that's a great question, Peter. It's ultimately a question of fact and degree. Okay, so for example, as Saul says, the PEO employer of record solution is a fantastic interim solution. But is it a long-term solution? Is it a 2, 3, 4 year solution for conducting genuine business activities, as opposed to an interim solution or a market scoping beachhead activity? No, it isn't. So it is a question of fact and degree. It comes down to a number of criteria, including, for example, number of people on the ground in country, activities on the ground in country, duration of time on the ground in the country. But it is a solution. It is a very good solution that is there, and indeed should be part of the kit bag in any M&A transaction.
Just in closing, this is the third consecutive quarter where value of the deals is topped $1 trillion. Anastasia, from a practical standpoint, what are you seeing out there? Are there capacity constraints? I mean, law firms, investment banks, everybody's busy. Any words of advice if someone's looking at a deal to try to expedite a transaction?
Yeah, I don't know if we would expedite the transactions. I do think we should be realistic and actually, buy more time to close this. And it's not only the constraints of the law firms. And law firms have a lot of associates to throw into the equation. We have a lot of resources to throw into the equation. I think it's just the actual government agencies that you cannot, nobody, I wish we can find a solution. Peter, in your Silicon Valley, maybe there will be a tech solution for government agencies to expedite that, but it is that our bottleneck. I think just the final words of advice here is be open-minded when you walk into a complex multi-country M&A deal. Know that you can plan probably for 70%, and there will be 30 where you just have to go with the flow, find options. And the good thing that I will leave you with is there's always an option. We'll find it if there is, and there's a solution. It might not be the one you planned for, but there is a solution.
Tom, any final words of wisdom before we go to Q&A from a tax and regulatory perspective?
I would agree with what Anastasia says. Certainly the world has changed over the last year. The world was changing anyway. Okay, there's increased transparency, there's increased disclosure, there is increased regulations, hoops to be jumped through. Certainly building time, okay, dealing with authorities, plan for the maximum amount of time that you can, and keep that 30% contingency and flexibility.
Well, thanks everyone. Appreciate the panel discussion. Let's open it up for questions and answers.
Okay, well, welcome back everyone. Saul and Peter will now be available for your questions. I don't see anything in the chat box just yet, but if you have a question, feel free to unmute and simply ask. And Saul and Peter, maybe you can talk a little bit while people are coming up with their questions.
Sure, I'd be happy to. I'll kick it off. So we covered this, we touched on this during the video, but I think one of the key HR issues we come across are really change of ownership and what sort of liabilities might be associated with that. Maybe you could just give a couple practical examples of things that you need to be thinking about.
One quick thing, Saul, sorry, Peter, can you turn on your camera so we can see you? Thank you.
Thanks, Yvonne.
Thanks for the question, Peter. It's interesting. I've seen it kind of run the gamut. Some elements that are probably pretty clear cut and not surprising. So, taking a look at a carve out where you have call it 10 employees in France, and certainly you want to ensure that these employees in whole move across to the new entity structure. All existing entitlements, benefits, compensation, extended, including holiday and everything else that you would put in place for those employees and their entitlement, all of that transfers. So the employees are kept whole, made no worse off. Perhaps that could mean, of course, supplemental benefits. You need to make sure you put that in place. Again, not changing any of the terms of their employment. So that's pretty straightforward and understood, I think, in a lot of cases. Good, though, for everyone to be aware of here. I've seen a nuance as well that was uncovered during some diligence, which is worth raising. And this is for a client that was looking to do a deal in Germany. The deal actually didn't go through in the end, but one of the elements they uncovered was 2 years in a row, the company had given a Christmas bonus to a number of employees. And that became an actual entitlement. It wasn't contractual, it wasn't anywhere, but it was a deemed entitlement to the employees because it had a fact pattern. It was historical there for the employees. Now, maybe that's not a huge number, right, in some cases, but it's just something to really kind of highlight some of the nuances that you should be aware of. And you are inheriting not just the existing compensation and, say, benefits pieces for those employees, you're also inheriting the legacy. So the years of service, the entitlements for potential, whether it be severance, or some countries, of course, are also going to have retirement entitlements that should be accrued, but not necessarily paid out. You see this in Italy, and it is intended upon termination that is paid out. And it may or may not, it should be though, noted on the book somewhere and clearly identified as a liability. But it just kind of highlights some of the little nuances that you might find and want to make sure that you're aware of when you're going through some M&A activity, because you will be owning that as the new employer going forward.
Interesting. So I want to talk to you more broadly about entity rationalization, but let's just discuss the T word, terminations. So a lot of times you're looking to cut costs in a deal. What are examples? How do you avoid landmines there when you want to do large layoffs or closures?
I think, again, there's going to be nuances by country and region along those lines, but I think you should expect, when you go into these deals, that you're really going to have some challenges to go through a full termination process. It's not to say you can't, but it can be quite expensive, right? So, you're going to run into some challenges in Europe around acquired rights directive and UK's version of that called 2P transfers, again, ensuring to keep the employees whole. And they have protections in place where you're actually not able to make, of course, without the employee consent, you're not able to make these changes to the employee terms. You're not able to separate and go through a redundancy process here without engaging the employees in this. You may be able to find a settlement that might be a possibility, but you have to make sure that you understand fully and appreciate the fact that I probably wouldn't look at this acquisition as an opportunity to save costs in the short term. Longer term, sure, of course, you get beyond a year into the deal and beyond. That might be an option, at that point, depending on the country. Another nuance, of course, is countries like Germany that have works councils, or if you're in France or Italy, Spain, you have collective bargaining agreements. Now, these are ones that are going to dictate actually the terms and what you can and can't do with the employees. And you're going to have to get approval actually from the local labor unions for these collective bargaining agreements. Again, there are limitations to what you can do from a termination standpoint, and you have to consult with some of these groups at that time. So I think you should certainly approach it as being a challenge if you really want to go into these deals and expect that you're going to significantly change the workforce associated with some of the deals.
So moving away from just the employee questions,
Yeah.
what happens when there's overlapping entities, and you're looking at this thing with a clean slate and saying, I'm in 25 jurisdictions and I really only need to be in 15 or 10, and I could see my way through the process where my operating costs could be much lower, but I've got to get from point A to point B. Any thoughts on that?
Yeah, so we're seeing a number of clients having gone through this, I think, recently, coming hopefully out of COVID here shortly, and that their business models have changed a bit. So you certainly do see it on M&A, without a doubt, but we're seeing it a little more around supply chains too, and I think it kind of ties in, where you find yourself with multiple entities. Let's say, for instance, the employees are able to be moved to one entity. Now you have an option to reduce these other additional entities that might be in place. Say you had 2 UK subsidiaries and you don't need the one. What do you do at that point? And I think there are means by which you can help to clean up some of these entities, save yourself on some of the compliance requirements at your end. To be able to do so, clearly you'll have to remove all the assets and liabilities from those entities, clean up the books from any intercompany transactions. So all of those are real possibilities from, let's say, a compliance standpoint. And that generates real savings. That generates ROI for the deal itself, and potentially, reduces the time required to do the annual compliance. One thing just to kind of keep in mind there, and I have seen challenges along these lines as well, is sometimes that intent is there from finance, let's say, but then the commercial teams actually say, well, hold on, we have a really strong brand in this entity, or we have some commercial loopholes or commercial thresholds that we want to avoid running into around deals in pipeline, or again, a strong brand ability to not impact the business or my ability as a salesperson to close a new deal based on this entity. So there's a couple of different ways of looking at some of these rationalizations and what you might or might be able or might want to do as a CFO or head of legal, head of compliance. When you look at these entities, it's not always just a clear cut. There's no employees here, we can just wind down this entity. There could be actually some other considerations that you have to factor in. Interesting.
Yvonne, I'm not seeing any questions in the chat box. If there are there others?
Yes, I think Kai wanted to ask a question. So
go ahead.
Yeah, just unmute yourself, Kai.
I just did. Hi, everybody. Thanks for the great presentation. I got a question which is more on the general perspective with respect to the M&A activities, like during COVID and hopefully soon after COVID. Where do you see the higher M&A activities now? Because we see there's a lot of interest in M&A activities into Europe right now. But can you echo that sense, or do you see more of a local M&A market? And how about Asia? And also, one thing I think is very important, at least from my perspective, what I see is, of course, the Brexit. What's the impact on in your business of Brexit and international M&A activities?
Peter, do you want me to?
Yeah, go ahead, Saul.
A little bit. Yeah, I can talk to a little bit of commentary around the Brexit piece. I think it's been really interesting. What we saw when Brexit was announced, right, and it was a long tail until the point of actually exiting from the EU for the UK, we started to see there some shift in our clients and perhaps how their structure was. Kai, I don't know if it was specific to really M&A per se. There were definitely some deals associated with that, where clients who historically had kind of a more traditional, let's call it hub and spoke model or operational model that worked through the UK as the primary. We started to see some activity with restructuring a bit or reshaping the organization a bit to have, let's call it a now European headquarters. So maybe they changed to Ireland or to Netherlands or somewhere like that, where you actually still had a foothold into Europe. You still had the ability at that rate to enter the single market through one of the European countries from a supply chain standpoint, whereas previously you might have been able to use UK for that. Now you no longer had that option. So we started to see an earlier shift, I will say, even prior to official Brexit, of our clients doing more business, setting up more entities in continental Europe, primarily, versus where they had operations in the UK.
Is that more to Ireland or the Netherlands? Because I mean, we see a lot, as you said, like the shifts for companies selling products or something to have a better place in the European, no, in a continental European country. Whereas from the tax perspective, it's often Ireland. Is that your impression too?
Yeah, I think that's right. I mean, I think you still benefit from the tax, the tax rates in Ireland. I think that's certainly going to be favorable, Kai, and Netherlands also has favorable tax rates too. I think it depends to an extent as well where you have the business. Are you going to have actual operations in that country, or is this something you're setting up strictly to benefit from the tax elements, assuming you have the appropriate structure in place too? So I think that has to be factored in. I mean, frankly, the UK has pretty favorable tax rates too, especially these days. But that there again, if it's an entry point into the EU and it's perhaps a supply chain benefit, you might find it slightly more beneficial just from a simple transportation standpoint, let's say into Netherlands versus Ireland at that rate.
Would you allow me another question? Since there aren't any others,
I don't think Saul's charging today, so go ahead, Kai.
Actually, it wasn't for Saul. That was for Saul. That was for Sue. I learned that you can set up a bank account in the UK in 2 weeks. So what's your magic wand here? Because I think it's so difficult to get a bank account in Europe in less than like 4 weeks to 3 months. How do you do that? You got a secret?
Was that you said that question was for Sue?
I'm not sure who said that on your presentation. I think it was for like setting up in the UK with 2 weeks, which
might have been Anastasia.
No. Anastasia. Sorry about that. Yeah.
I see Annie's on the call as well. I think what she was referring to is a relatively new development last few years, the employer of record, where you can basically rent a spot in somebody else's pre-existing entity and get a payroll up and running. If you're setting up a legal entity on behalf of the client, that's usually a transition period where you'll move the employee from the employer of record into the normal payroll once the entity is complete. Depending on what the commercial activities are, there are some non-bank bank accounts. There's some trust accounts that you can use to get a payroll up relatively quickly. We use that in about 45 countries. The UK is one of them, but it's not going to be sufficient if you need a bank account for commercial purposes. So that is I think something that we've seen that's really changed the landscape quite a bit. If you have a transaction and you're looking at trying to get 10 or 20 countries set up, usually there's going to be some number of those countries where you can use this employer of record solution to get a basic payroll underway while you're figuring out what the longer term entity structure is going to look like. And in many cases, maybe if it's a small employee count, that you may continue with the employer of record solution indefinitely as well.
Peter, I might just echo that a little bit further, Kai. Where we see our clients have some success is hopefully if you're operating in the US and you're working with a global bank already, that you can potentially lean on your US relationships, your US bankers, to do the same for the European colleagues if they have a global bank network. So that's just one thing that we recommend. If you happen to be fortunate enough to use a bank that has operations outside of the US, that can pave the road for you sometimes, to not have to go through such an extensive process.
To speed up the KYC.
To speed up, yeah, that's right. Yeah. It's not to say you'll avoid it, but your current bank likely has a lot of that information already at hand. Maybe can appease some of those requirements to an extent.
Thank you.
Great. Well, thanks everyone for attending. We appreciate it. Back to you, Yvonne.
Well, thank you so much for having this panel discussion with us today. Thank you to everyone who joined us. If you have any further questions to anyone of the Vistra team, let me know and I will be happy to connect you with them. Otherwise, we'll see you at another event soon. Thank you, everyone.
Thank you.
Thanks, guys.